If you Google what credit score do you need to buy a house or minimum score for a mortgage, you'll usually see 620. Sometimes you'll see 580. And those numbers aren't random. They come from real agency guidelines. But here's the problem. Those numbers are starting points, not the full picture. And that's why people get frustrated when their lender pulls a different score or says something they didn't expect. So let's talk through what actually matters. Let's start with conventional loans because that's where most buyers begin. You'll hear over and over 620 is the minimum credit score for a conventional mortgage. And in many lending environments, that's operationally true. But if you open the Fannie Mae selling guide, section B3-5.1-01, general requirements for credit scores, you'll see something most people never look up. It states a minimum credit score is not required for DU loan case files. DU stands for desktop underwriter. That's Fannie Mae's automated underwriting system, or AI. That means the system itself does not impose a universal hard minimum score when it's evaluating an automated approval. Now, that doesn't mean you can have terrible credit and get approved. It means the automated system evaluates overall risk, not just one number. And here's the nuance. If the loan is manually underwritten instead of run through automation, Fannie Mae does publish minimum score requirements generally, 620 for fixed rate loans. So when someone says 620 minimum for conventional, they're not wrong, but the underwriting path matters. And that's especially important if you're comparing lenders because not every lender has the same overlay requirements. Freddie Mac works in a very similar way through its automated system, Loan Product Advisor, or LPA. And you can see their credit evaluation rules in section 5202.5 of the Freddie Mac Seller Servicers Guide. Now let's talk about FHA because that's where the 580 number comes from. HUD's FHA Single Family Housing Policy Handbook 4000.1 lays it out clearly under minimum decision credit score. If you have a FICO score of 580 or higher, you're eligible for maximum financing. If your score is between 500 and 579, you may still qualify, but typically with at least 10% down. And that's where the 580 score comes from. But here's what most people don't realize. Lenders can impose overlays, and an overlay simply means the lender chooses to be stricter than agency minimums. So if a lender says, we require 620 for FHA, that's not a HUD policy. That's a lender's risk policy. Now let's move on to VA, because this one gets misunderstood constantly. The Department of Veterans Affairs does not have a minimum credit score requirement for a VA home loan. That's stated in VA pamphlet 26-7, chapter 4, under credit underwriting. The VA leaves underwriting standards and credit evaluation to the lender. So again, if a lender requires 620 for VA, that's a lender overlay, not a VA rule. USDA follows its own guidance under HB-1-3555, Chapter 10, that explains how credit scores are selected and validated, including using the middle score of 3, the lower of 2, or the single score available. So already you can see something important here. There is not one universal minimum credit score for a mortgage. It depends on the loan program, whether the file runs through an automated system or manual underwriting, and whether the lender applies overlays. Now let's shift from minimums to what actually happens when you apply. When a mortgage lender pulls your credit, they order what's called a Residential Mortgage Credit Report, or an RMCR. That's a tri-merged report. It pulls data from Experian, TransUnion, and Equifax, and it generates a mortgage-specific FICO score from each bureau. And here's where the confusion begins. Fannie Mae's selling guide, section B3-5.1-02, explains how the respective credit score is determined. If 3 scores are available, the lender must use the middle score If two scores are available, they use the lower of the two. And if a single score is available, they use that single score. So if your scores are 732, 711, 735, your middle score is 735. That's why many borrowers think that the lender pulled the lower score. They didn't lower anything. They applied the required rule. Now let's address the big question. Why is my lender's score different from what I see in my app? Well, because there's no single FICO credit score. There are multiple FICO versions. There are multiple industry-specific models, and there are completely different scoring systems. Historically, mortgage lenders have used the classic mortgage models, FICO Score 2 for Experian, FICO Score 5 for Equifax, and FICO Score 4 for TransUnion. Most consumer apps show FICO 8, FICO 9, or the VantageScore. And VantageScore is a model that is made up of from the three bureaus, which is completely separate from the FICO. It's a different algorithm. It's different output. So when your app says 742 and your lender pulls 711, nothing is wrong. You're looking at different scoring models and sometimes different bureau data. Now let's talk about inquiries, because this is part that scares people. When you check your own credit, that's a soft inquiry. And soft inquiries do not affect your score. When a lender pulls your credit for a mortgage application, that's a hard inquiry. FICO explains that a hard inquiry typically has a small impact, fewer than 5 points for many consumers, depending on their overall profile. But here's what most people don't know. Multiple mortgage inquiries within a certain rate shopping window are treated as a single inquiry for scoring purposes. So depending on the scoring model, that window ranges from 14 days to 45 days. So if you shop 2 or 3 lenders within that window, it generally does not count as multiple hits. Next, let's define one more term that you hear constantly, LTV. LTV stands for loan to value ratio. It simply means your loan amount divided by the property value. So if you borrow $360,000 on a $400,000 home, then your LTV is 90%. Your credit score, your LTV, the occupancy type, whether it's a primary, second home or investment property, and the property type, whether it's a single family or condo or whatever, all work together to determine pricing for interest rates. Fannie Mae publishes the official loan level price adjustment matrix, and Freddie Mac publishes similar credit fee grids under Exhibit 19. These grids show how different scores, credit score ranges, and LTV buckets affect loan pricing. So credit doesn't just determine whether you're approved. It determines how expensive your loan and the fees are. And that's why understanding how your mortgage credit score is calculated, which model is used, how the representative score is selected, and how pricing tiers actually work. And that matters far more than memorizing 620. At the end of the day, there isn't just one credit score. There are multiple scoring models, different bureau data, specific agency rules for score selection, and lender overlays layered on top of it all. Your mortgage approval isn't based on the number in your app. It's based on the scoring model required for mortgage underwriting, the representative credit score rules set by agencies, and how the full credit profile fits within the agency guidelines. If you take one thing away from this video, let it be this. If you're buying a home, don't chase a random number. Understand the system, because once you understand how mortgage credit is actually evaluated, from tri-merge reports to middle score selection to pricing adjustments, you can make strategic decisions instead of emotional ones. I've included direct links to every guideline and every handbook I reference in the description below, so you can verify everything yourself. In the next video, we're going beyond credit and into the hidden cost of buying a house and cash to close versus down payment. If this video helped you, please subscribe. My goal isn't to sell you anything, it's to make sure you understand the rules before stepping into the game. I'll see you in the next video.